Welcome to IMC's Trading Masterclass. I'm Darcy and I'm a trader here at IMC. I've been trading here for 3 years and I work on the Hong Kong equity options team. Today, we're going to be taking you guys through some of the theory behind trading, as well as walking through some practical examples of how that plays out in real life. We've got a couple of sessions for you, and those sessions include what a market maker is and why is it critical, skew in options and what happens during a takeover, what does a short squeeze mean and how can short squeezes hurt, negative crude oil prices and how it relates to futures theory. All right, let's get into it.
Hi everyone, my name's Anthony and I'm a trader here at IMC. In today's session, we're going to talk about market making. So what do we want to learn in today's session? Firstly, we want to be able to explain what market making is with some basic terminology. I want us to run through an example of market making in real life, ideally in a scenario that we've all seen before, a currency counter at an airport. And then also, I'd like to talk about why market makers are important in modern financial markets. So to start off with, I'd like to go through some terminology that will be useful to the session today. So the first word I want to introduce is order. So an order is something that you place in a financial market, and there's 4 important bits of an order. So firstly, the side. Do you want to buy or do you want to sell? Secondly, the product. What do you want to buy or sell? Then the price that you want to buy or sell at. And lastly, the volume. So these things make up an order. For example, I want to buy 10 shares of Apple at $300. I'm actually not sure what Apple's trading at the moment. That could be very off the mark. And so then, once you have an order, we can say that orders to buy, we'll call them bids. Orders to sell, we'll call those asks or offers. So a bid is an order to buy, an offer is an order to sell. Okay, so now we can kind of draw out a hypothetical market on the board here. I'll just deal with prices. We can just assume all the orders are for one lot. So we can have our bids on the left and our asks on the right. So let's say there's 2 orders here. There's 2 people in this market that want to buy. Someone wants to buy at $8 and someone wants to buy at $7.50. Similarly, there are 2 people in the market that want to sell. Someone wants to sell at $9 and someone wants to sell at $10. So this makes a market for us with 4 orders. So we can now say the bid with the highest price, so the most competitive bid, the person that is willing to buy for the most expensive price, this $8 order here, that's the best bid. Similarly, the ask with the lowest price is the best offer. The bid-ask spread for a market is then the difference in price between the best bid and the best ask. So here the bid-ask spread for this market is $1. If we remove this $9 order, so if this person didn't want to sell anymore, the bid-ask spread for the market would be $2. The difference between the $8 buy and the $10 sell. We can now introduce the concept of the liquidity of a market. So liquidity is to do with the transaction cost of the market and how much it costs to trade. Generally, a higher liquidity market has a lower bid-ask spread, and that also means it's cheaper to trade in that market. For example, an index in the US or a share of Apple, these are markets that lots of people are trading. They're very competitive, they're very high liquidity. The bid-ask spread is very small, and they're very cheap to trade. In contrast, a low liquidity market could be something that people aren't as interested in trading. For example, a share of a very, very small Australian company without a lot of interest. There might not be a huge amount of bids or offers. The bid-ask spread might be very, very wide, and it might be quite expensive to trade. So that's an example of high liquidity and low liquidity markets. The final concept I want to introduce is the idea of a theoretical. So a theoretical is a market participant's idea of what they think a product is worth. So in this market, we can see some people are willing to buy for $8, $7.50. Some people are willing to sell for $9, sell for $10. It looks generally like people in this market think this product is worth somewhere between $8 or $9. This person here who's willing to buy for $8, you'd think they think that this product is worth more than $8 because they generally want to buy for less than what the product is worth. The fact they place an order for 8 here doesn't tell you whether their theoretical is $8.10 or $8.70. It just tells you they probably think it's worth more than $8. But so every person in a market independent of the orders they place, also has a theoretical, just what you think the product is worth. So hopefully that's a bit of a glossary that can help with the rest of today's session. We can now talk about how market makers trade and how market makers try and make money. So in a market makers are continually providing bid orders and ask orders and providing liquidity to the market. They're trying to make a market have more liquidity, a lower bid-ask spread, and make it cheaper for other people to trade in. This sounds hard though. Why would you be a market maker? Because if you're always providing orders, a lot of people will trade against you, and that could be quite risky. The key to being a profitable market maker is ensuring that a similar amount of people buy against you as sell against you. So you can capture the bid-ask spread, make some money by doing that, and then stay relatively risk neutral. This is good, but it requires you to have a high degree of confidence in your pricing. If enough people disagree with you asymmetrically, if you create a price that everyone wants to buy against, this means you'll just trade in one direction, take on a large amount of risk, and you're at the mercy of the market as to whether you make money or not. Ideally, you set pricing and place orders such that a similar amount of people buy against you as sell against you. You can provide liquidity to the market, allow other people to get the positions they want, while you can remain risk neutral and just continually capture the bid-ask spread. So now we can talk about market making in an area that should be known to all of us, the idea of a currency conversion counter. You find these in CBDs or in airports. So imagine you're going on holiday to America, you've got 100 Aussie dollars in your pocket, and you walk past the Travelex counter. They will provide you a price that they're willing to buy US dollars for and sell US dollars for. If you take your $100 and change it for US dollars, you might get 65 US dollars. If you showed up to the currency counter with 65 US dollars and tried to exchange this back for Australian dollars, how many Australian dollars do you think you'd get? Ideally, it's less than 100, or ideally for the currency counter. If it was more than 100, you'll just stay there all day exchanging your Aussie for US dollars, exchanging your US dollars back to Australian dollars and just making money out of nothing, and they would go out of business very quickly. So the currency counter is a price they're willing to buy US dollars for and a price they're willing to sell US dollars for. And this difference is the spread. So as a currency counter, why don't they make their spread really wide? Why don't they say, I'll take you 100 US dollars and give you 100 Australian dollars and give you 10 US dollars back? Or, I'll take your 10 US dollars and give you 1 Australian dollar back. This would make, a really uncompetitive market. It'd be very low liquidity. There'd be a really big bid-ask spread. Well, in a market like this, other people could just join. Someone could see there's a very uncompetitive currency converter there, and they'd say, hey, I'll set up shop at the airport. I'll make my prices a little bit better. And then no one will trade with the uncompetitive person. They'll trade with me. So more people join the market. The market becomes more efficient. The bid-ask spreads tighten. Liquidity increases in the market. Till the market, reaches an effective equilibrium where everyone is effectively quoting as tight a spread as they can without losing money. So, this sounds like a pretty good business though for the currency counter. They can continually, buy and sell US dollars, always make the spread, walk away with a bit of money, awesome job. What's the risk? Well, as we're explaining in the introduction to how a market maker trades, ideally you can keep your position risk neutral. But imagine if a really rich person, they rock up to the airport with 10 million or 20 million Australian dollars and they try and convert that all to US dollars. This will give the currency counter a really large position in US dollars. They're not going to be flat. They're not going to have, bought 100 US dollars and sold 100 US dollars. They're actually going to have traded one clip in really, really large size. As this person who's just bought all the US dollars goes on holiday, the currency counter is now really short US dollars. And if the Australian US dollar pair moves, the currency counter could then make or lose a really large amount of money. So this is what I was saying before about you need theoreticals that are going to cause a similar amount of people to buy or sell with you. But yeah, there is still a risk here that you take on a really large asymmetric position and you're at the mercy of the market, whether you make money or not. But yeah, so hopefully a currency counter, an example that we've all seen and all interacted with. This is an example of a market maker in a day-to-day real-life business. Just to finish up, I want to talk about a couple of points as to why market makers are important. So in the currency example, It's pretty clear why market makers are important. It'd be really frustrating if you were going on holiday to the US or Europe with your Australian dollars and you couldn't switch that for the local currency. You need to be able to trade, you need to be able to use the market maker to go on holiday. In a more tangible example, you probably have a shared trading app on your phone where you can buy some stocks or some ETFs. Every trade needs a buyer and a seller. The fact that you can always open up your phone and say, I'll buy 10 shares of that, and someone's willing to sell it, is because of a market maker. Market makers are always there providing prices, providing liquidity to the market. If market makers weren't there, you might go onto this share trading app, want to buy 10 shares of Combank, it might take you 3 days to trade. There would be far less liquidity in the market and it would make financial markets a lot more dysfunctional. Market makers are also really important in times of crisis. For example, during COVID-19. That was a very uncertain time. Markets were moving around wildly. There was a lot of uncertainty. Market makers step into markets, always provide prices to buy or sell at, meaning people under financial duress or people who want to speculate always have someone to trade against. Without market makers, while markets obviously, did have a quick fall and rebound, it's not unlikely that markets would have fallen a lot further. There would have been no liquidity in the market. In the peak times of COVID, there was a lot of uncertainty and not many people were willing to stand there and say, I'll buy stocks now. And that can have a much broader impact on the economy. If people's superannuations are falling 30 or 40% in a month, that has much wider impacts than just the financial market. So the fact that market makers can kind of step in and give some more order and give some more liquidity to the market can be really important in times of crisis. So hopefully you guys have learned a little bit today about market making, some terminology about trading and markets in general, a little bit about how market makers trade, how market makers aim to make money, and some real life examples. Firstly, the currency counter, and secondly, some more tangible examples about why market makers are important for functioning financial markets.
Hey guys, my name's Anna. I've been a trader here at IMC for about 2.5 years now, and I'll be taking you through options theory, volatility, and volatility events today. What this section will cover: what is an option? What is volatility? Volatility trading with options. How does IMC trade and price options? Why do people trade them? And interesting volatility moments. So, what are options? They're a financial instrument based on an underlying security like a stock, an index, a commodity, or an ETF. A stock is, for example, Tesla, an index, S&P 500, a commodity is gold. An ETF is very similar to an index, but it trades on an exchange like a stock does, so it's much more accessible to you and me. What are options? The right, but not the obligation, to buy or sell an underlying asset at a certain price and date. Why would anyone ever trade options? To hedge against risk. For example, airlines hedging against oil prices or McDonald's hedging against beef prices, and to provide leverage and more complex strategies. So buy or sell. What does buy or sell mean? Well, a put will give me the right to sell an underlying asset at a certain date, and a call gives me the right to buy. So what is the price? We call this the strike price. It is the predetermined purchase price at which a security may be bought or sold. For example, Nvidia shares are currently trading at $820 US. If I bought an $840 strike price call, then I could buy Nvidia shares for that price at the future. What is the date? All options have an expiry date. At this date, the options will either expire worthless or the difference between the current underlying price and the strike price. The number of expiries can be different across all markets. For all markets, they will have at least one expiry per month. In Hong Kong, it's the second to last working day of the month, or Korea, it's the second Thursday. Some markets, like the S&P 500 or Nikkei, have expiries listed out until the end of 2029, and they also have dailies, weeklies, a number of other expiries. They can also have slightly different types of expiries. Options can either be American or they can be European. American options can be exercised at any time prior to the expiration date, whereas European options can only be exercised at expiration. So what does an option look like with all these details? This one's a call with an 80 strike price that expires in the middle of June and is a European option. If this is the call payoff, what's the max amount that each party can make? For an option trade, there'll be a buyer and a seller. In this scenario, the buyer can lose the $3 premium that they paid for the option, and the seller can lose an infinite amount of money. So if you're going to go selling options, you better be careful. What are the contract specifications of the option? We have things called the contract size, which is different across all markets. It's how equivalent your options are to the stock. The kind, call it put, the strike, your strike price, the expiration date, American or European, and settlement. Settlement's the one we haven't covered so far. That involves whether or not at expiration you either receive the actual underlying or get paid in cash for the difference between the underlying price and the strike price. But what else are we not considering? Consider the next two stocks. Procter & Gamble is a multi-consumer goods corporation. NVIDIA is a technology company mainly focused on AI, high-performance computing, and gaming. How did the return of these two stocks look over the last 6 months? Procter & Gamble is up 5% and NVIDIA is up 71%. What would the volatility of NVIDIA be compared to Procter & Gamble? NVIDIA volatility is much, much higher than Procter & Gamble, trading at about 44 at the moment versus Procter & Gamble's very low 4. What is volatility? Technically, volatility is the statistical measure of the dispersion of returns of an underlying asset. So 71% versus 5%, NVIDIA volatility is much, much higher than Procter & Gamble. And therefore, NVIDIA should also have more expensive options. Now take a look at this graph. As you can see, volatility is very important for options because if the stock is higher volatility, it is more likely that the option will end in the money, as in further above the strike price at expiry. So on our 80 strike price call below, it's much more likely that the stock price will end at 100 than it would if the volatility was the same as Procter & Gamble at 4. At IMC, we care about 3 different kinds of volatility. 2 of them are historical, and we call them realized and historical volatility. Realized volatility is the measured historical dispersion of an underlying asset, so how much your stock actually moves. Historical volatility is what the options implied in the past for the volatility of the stock, and implied volatility is what the options imply currently for the future volatility of a stock. So I've given a lot of inputs. How do we actually price options, and how do we price options in a live market? One way to model this is using the Black-Scholes model, a complicated differential equation introduced more than 50 years ago, widely used to price option contracts. It uses 5 inputs: strike price, current stock price, time to expiration, risk-free rate, and volatility. All of these we've mentioned, except for risk-free rate. We care about this because the expected value of your stock price at expiration is not the same as your stock price now. So how do we do this in real time? We can do it through theoreticals, so realized and implied volatilities, bond implied risk-free rates, expected dividends, fair implied probability distribution functions, or we can also do it through supply and demand. So take our option prices and look at where other people think they should be and back out what our inputs are. This can give us a volatility curve for one expiry that looks like this. It can also do it for one expiry that looks like this. So depending on how much you can trust all your inputs, depends on how your vol curve will look. So why do these volatility curves look different? Well, firstly, this can occur because Black-Scholes model isn't perfect. It makes a number of assumptions. Firstly, no dividends are paid out by any stocks. Markets are random. It doesn't cost to trade. The risk-free rate is known and constant, which anyone trading from the past 2 years knows is not true. The returns of the underlying are normally distributed, so it ignores black swan events, COVID, GFC, Black Monday, and the options are European. We already established before they can also be American. So we know our model isn't perfect. Do we also fully understand supply and demand? Why is there supply and demand imbalances? When do they buy and sell? Why do they buy and sell? And who is buying and selling? On the screen, you'll see a number of different people who might buy or sell for different reasons. Asset managers will generally be long stocks, so they might sell calls to hedge their risk. Retailers might buy options for completely different reasons. For example, in Korea, it's illegal to gamble, so they will often come in and just punt on the direction of the stock on the day. Hedge funds will generally come in to buy puts to hedge their total portfolio risk. And banks will issue something called structured products, which they will then sell on to retailers and are reasonably price independent in their hedging. So why trade options? They're cost efficient, they reduce risk, they have more complex strategies like calls, puts, straddles, strangles, risk reversals, iron condors, jelly rolls, and they have higher potential returns. So we've talked about options, we've talked about volatility. Let's talk about volatility when it's been a volatility event. One that people may have not heard about but happened 40 odd years ago is Black Monday. The S&P 500 dropped 20.4% in one day, and the Dow Jones Industrial Average dropped the most it's ever dropped, more than 22%. This started in Hong Kong, bled out to the rest of Asia, Europe, and then the US, but was pretty much over within 5 days. Another cause was the introduction of computerized trading. Computerized trading is like what IMC does now. It was pretty new in the 1980s, and on Black Monday, it allowed traders to place more large orders faster, creating a domino effect. The final one is portfolio insurance. Like computerized trading, it was a pretty new phenomenon in the 1980s. It involved large institutions selling S&P 500 futures to hedge their portfolio risk instead of the much smarter way they do it now, which is buying puts, which meant when the market opened and they want to hedge their outstanding longs, they just went and sold a whole lot of futures. So what happened to volatility? Let's take a look at this graph. During the last 10% rally of the S&P 500, real volatility had already risen from 8 to 15, so people were looking a little bit worried. By the time Black Monday occurred, we'd already seen a decline in the stock market, about 16% from the high, and volatility was materially higher at 25. But what about Black Monday? Short-term volatility rose to 130 on the day, but quickly dropped as the downtick failed to materialize in the next few days. And by the time 3 months in the future, despite a 20% downtick, vol was already back to 10. So what did Black Monday teach us? I told you before that Black-Scholes was flawed. Black-Scholes didn't used to have what we now call a volatility smile that you will see on this graph. Another big volatility event that people have probably heard about is the GFC, which happened 2007 to 2009, but mostly in 2008. It's the most severe economic crisis since the Great Depression, and over the time of the GFC, the S&P 500 dropped 57% from its highs. So what caused the GFC? I'm not going to give you a full rundown, but in the years leading up to the GFC, economic conditions in the US, they were pretty good. People wanted to borrow more, growth was strong and stable, inflation was low, unemployment was low, and interest rates were low as well. House prices were going, everyone wanted to borrow, everyone wanted to buy, and no one wanted to regulate it. Everyone wanted to keep going, the banks kept issuing, they kept giving out loans, and this just became too much. So what was the tipping point causing the GFC? House prices started to fall, there were stresses in the financial system, started to spill over into the other countries, and financial firms started to fail. So what happened to volatility this time? In 2008, volatility was already creeping higher, with people feeling the stress in the financial system. Just before things got really wild, 2-week volatility was already at 41. As an example, S&P 500 volatility at the moment is about 10. From there, the S&P 500 fell another 27% in 5 weeks, which saw short-term volatility go to almost 100. During this time, the VIX, which is a volatility index, went from 36 to 80. In the year following, volatility normalized with 2-week vol around 20 to 23. So where does a firm like IMC make money in these volatility events? Let's say, for example, it's July, I've started hearing about these financial firms, I feel like things aren't going that well, and I buy the current strike price 1300 put with the underlying at the same level. It expires in December. In August, things start getting really hairy, the spot starts sticking down, and it's suddenly at 800 by the end of October. I've made money in 2 ways. I've made money from the spot price versus my strike price is now a $500 difference. And as we know, implied volatility went from 40 to almost 100. So I've either made money on the difference between the strike price and the spot price, or I've made money because I can now sell my put back for more than it was worth before. And that's the end of this session. We covered options and what goes into them, volatility and why it's so important for options, how you trade that volatility with your options, how IMC does it, how other ways you can approach it, and interesting volatility moments and how you can make money off them. I hope you enjoyed the session.
Today I'll be taking you through skew and options and what happens during a takeover. So first, what we want to talk about is build a little bit off of what Anna took you through in the previous session. So Black-Scholes model makes some assumptions about how the underlying stock moves, but what are these assumptions? So you can see from the graph in the table above that essentially what we're assuming is a stochastic process or a Brownian process or a Werner process. These are a collection of names for pretty well-known statistical behaviors where essentially we think that the stock or the underlying or the future walks randomly through time. We don't try and make claims about where it's going to be in the future exactly. The only thing we're really trying to make a claim on is how randomly it walks through time. Things that are low volatility don't tend to move from where they are right now very much, and things that are high volatility tend to move a lot. And as we saw from the previous section with Anna, that volatility implicitly gives you a difference in the value of your option. So how do we use Black-Scholes to get from a formula into something that is pragmatically useful for us? Well, what we do in practice is typically we know all of the variables that we need in order to price an option, except for one. And that one is the future volatility of the underlying that we just discussed. So in the event that we're trying to price an option, essentially we're using Black-Scholes as a bijection. We go from implied volatility to a price of an option, or we go from the price of a particular option at a particular strike into an implied volatility. And so essentially what this means is when modeling and thinking about options, we typically do it in what's called a volatility curve. And what we mean by that is we're backing out from the strike of an option what the implied volatility is and visualizing our options pricing in that form. So what does a Gaussian look like in an implied volatility curve? And the answer is fairly benign. It's essentially just a flat line where on the x-axis we have the strike of the individual options in the series, and on the y-axis we have whatever the implied volatility is. So that one, not particularly interesting, but what we'll be doing today is looking at some examples of properties which make those volatility curves more interesting to trade. So when looking for non-trivial parts of a volatility curve, we get brought back to moments of a distribution. Moments of a distribution are statistical quantities that express underlying attributes of the distributions that we're studying. We've already met two of them, one being the mean and one being the variance. And while the formula above may look somewhat ad hoc, it turns out that for all of the different n's, n being from 0 to infinity, that the qualities that we get out of these moments of distribution are in fact quite meaningful and quite intuitive. So the first two, mean and variance, I think speak for themselves in that they're in our Werner process and Brownian motion process formula. But the interaction between the two that we're going to discuss now, that being the third moment skew and the fourth moment kurtosis, is going to be pretty evident in our vol curve pricing as well, and also in the vol curve pricing we see in the market when we look at the takeover of Twitter later on. So firstly, let's talk about the skew of a distribution. The skew of a distribution is the third moment of a distribution and essentially measures the asymmetry of returns. Now it's important to remember that this isn't the same as saying that a stock is going to go up or down. If that was the case, we should simply buy the security because it's cheap or expensive. Instead, what it's saying is that if it goes up, the conditional distribution then will be much different to if it goes down. We can see this in the graph on the left, where if we looked purely at a Gaussian distribution without any skewness, it wouldn't be able to explain why the tails of one graph look significantly different to the tails on the other side of the graph. Another way of putting this is saying that if a stock goes up, that we expect it to rip up much further, but if a stock goes down, we expect it to be fairly uninteresting. These kind of properties of a distribution are very physical things that can happen to companies, and they're not explained by the earlier moments in the distribution. But what do they actually look like on our volatility surface? So the graph on the right demonstrates that, and that essentially means that if we expect explosive upside, that our options on the upside should get more expensive. Equally, if we expected explosive downside, you'd expect the volatility surface to have a negative gradient associated with a negative skew. What about kurtosis? So kurtosis is the fourth moment of a distribution, and it represents the symmetric tailedness of the distribution. The graph on the left highlights that quite clearly, with the red line being a normal Gaussian distribution, while the green line shows what happens if, conditional on any movement, we expect more explosive movement in the future. This is not an unintuitive property for a stock or equity to have. If something starts moving, you may believe that there is a reason for that movement, and so more movement will ensue in the future. Whereas if things are relatively stagnant and stale, that they're more likely to remain that way. But what does this mean for our volatility surface? So we can see in the graph on the right, a fairly intuitive graph as well. In the case of the green line, if we do have this more explosive up or downside or symmetric tailedness, that our out of the money or far away options should get more expensive. In order for options to get more expensive, their implied volatility has to go up. And so we see that there is essentially a cup nature to our volatility distribution, which represents the fact that with our fat tails or our high kurtosis, that the wing options are being priced as more expensive than they would in a simple Gaussian case. So while academically interesting, I've promised you guys that this is going to be pragmatically useful in our trading. And so we're going to look at the Twitter takeover. It's one of the clearer examples in the last couple of years of how these moments in distributions become important in our options trading. So in January 2020, Elon Musk began accruing a position in Twitter. By April, he'd accrued a 9.1% position, at which point he offered to the board a $54.20 takeover price. Now, what did this mean for the equity? It means roughly what you would expect. We can see from the graph that the equity started trading up, and by mid-April, it was trading significantly higher than it was earlier and quite close to the $54.20 mark that Elon had promised. By July, however, Elon had said that he was reneging on the deal, citing issues with spam bots, and was essentially trying to back out of the whole operation altogether. What happened here is, again, what you might expect. The equity started trading closer to what people thought Twitter was worth if Elon wasn't willing to pay $54 for it. And finally, after a lot of back and forward and a court date was set, on the 17th of October, Elon Musk for the final time said that he was going to renege on his renege and was going to go through with the deal. For 10 days, we somewhat sat in limbo as the stock traded up towards the $54 mark again. And then on the 27th, the deal closed and the equity was delisted from the exchange. But what does this do to our volatility curve? Well, in modeling this, it's essentially a binary event. Either this deal does go through at $54 or it doesn't go through. The second thing is that we can see from the magnitude of the spot moves that we're seeing around the time that Musk news is coming out, that this is the dominant driver of the Twitter stock price. So when we're pricing our volatility curve, we'd expect this to have a very dominant effect on the general shape of our options pricing. So under what conditions are we going to see this impact our moments? Well, looking at the equation below, skew is pretty clearly going to be affected in some capacity, but where is that capacity the most dramatic? Well, some examples would be any example we can think of with asymmetry. So if we think that there is a small chance of a very large downside and a large chance of a very small upside, this should exhibit skew, which is essentially the behavior that we were seeing all throughout this case, where Musk had made a promise and yet there was still some possibility of reneging. It's a possibility that he inflamed when he reneged the first time and didn't do much to disquiet when he came back on the 17th out of nowhere and said that he was going to renege again. The question is this what we saw in our volatility surfaces? So above are 3 volatility surfaces from over the course of 2022, which exhibit the behavior. The first one I want to draw your attention to is the green line. That is what the volatility surface of Twitter looked like before the market was acutely aware of any takeover bids. So that represents essentially a baseline. You can see it exhibits some kurtosis and some skew already, with the wings being slightly higher than the at the money points, and the puts, or the downside, being slightly more expensive than the upside. This is just to say that people think that that's the typical distribution that an equity, and in this case Twitter, usually should have. But now we draw our attention to the red line, which was taken in July. This is after Musk has already reneged, and while it seems from everything we're hearing from the media that there is not that great a chance he'll be able to successfully renege, he's certainly increased the likelihood that he's not going to go through with this deal. So what does this mean for us? It means that there is some chance that Twitter trades significantly lower than where it's been trading for the last couple months. And what that means for our volatility surface is that there is a significantly greater component of skew. And we can see that in effect in the red curve on the downside, where the puts are significantly more cheaper relative to the at the money than they were a couple weeks earlier. Finally, the October graph. So at this point, Musk has come back and claimed that he is going to settle, and essentially what we're waiting for is the funds to land. So why then do our volatility surfaces look anything other than just a guaranteed this will settle? Well, there is some very small probability that this deal doesn't go through, and for that there's still some premium on the downside to the puts. But what about to the upside, above $54.20? Well, this is probably the most interesting part of all of it. There is essentially, according to the market, no probability of this equity trading above that price. That if the deal goes through, it will go through at exactly the price that Elon Musk had quoted, and if it doesn't, then it's going to fall right back to where it was trading before, which is why we get this rather atypical flat line on the upside with significant bid on the downside. So what have we covered today? Well, the first thing we looked at was the idea of a volatility curve, which takes us from the relatively abstract Black-Scholes into a fairly concrete, intuitive, and physical understanding of what option pricing means. The second thing we looked at was maybe the more theoretical understanding of moments of a distribution. And then the third thing we looked at was pragmatically, in particular in this case in Twitter, how corporate action can necessitate the use of moments of a distribution in order to correctly price and model what we're trying to express in the equity market.
Hi. In this session, we're going to take a deep dive into why oil futures went negative during the COVID-19 pandemic. To start off with, I'll explain what a future is. A future is a financial instrument where you can take delivery on a certain product at a certain time in the future. So how do we define what a future is? To start off with, there's the underlying of the future. This is what the future is based off of. This can be a whole range of things. You can get futures on indices, such as the S&P in the US, the Nikkei in Japan, or the Kospi in Korea. You can get futures on commodities, such as oil, which we'll explore today, and then other things like orange juice concentrate or hogs. You can take futures on forex pairs, so for example, the Aussie dollar, US dollar pair. You can take futures on things like treasuries, so government bonds. You can get futures on a whole range of financial products. So that's what we call the underlying, so what you're actually trading a future on. The next thing is the expiry. When will you take delivery of your underlying? This could be a week from now, a month from now. Some really liquid products, like some indices in the US, have futures that are 5 or 10 years in the future. So you'll be trading a future now to take delivery of an index, maybe in 2034, 10 years from now. And then the final thing that defines how a future is written is the settlement. This defines at this future time how you will either deliver or take delivery, whether you're buying and selling, your underlying. So in a lot of examples, your future is cash settled. You need to give a sum of money that is what your future is settling to. Whether you're buying a stock or an index at a specific price, you take that amount of cash and give it to your counterparty. For some other products, futures are physically settled. So this is often the case for commodities. So for oil, futures are often physically settled to a place in Cushing in America. So you actually have to rock up to Cushing with your truck or your oil tanker and actually take delivery of the oil there. Similarly, things like cattle futures are also often physically settled, as well as metals. So, you'll actually have to go to a specific location and pick up all your gold bars, so they're not cash settled. So these three things, underlying, expiry, and settlement, they define a futures contract. It'd also be good to briefly touch on why you would want to trade a futures contract. So there are three main reasons why people would want to trade a futures contract. Firstly, speculation. People want to predict whether prices go up or down, and futures give a really liquid instrument for you to trade this. If you think the S&P is going to go up or you think gold is overvalued, the future is a natural instrument that you will trade to take a position on this. Secondly, hedging. So, large companies, farmers, people have exposures to the prices of indices and more often commodities. For example, someone like Qantas, they have a large exposure to the price of airline fuel. If plain fuel becomes more expensive, Qantas will make less money. They might trade an oil future to hedge this. They want to make money on their oil future to offset the losses they will make if plain fuel becomes more expensive. So firstly, speculation. Secondly, hedging. And then thirdly, futures are quite easy to trade because they have less restrictions than trading equities. It's easier to short sell. You don't have to put up as much money at the start to trade them. So there's a lower cost of trading with futures. They're often more liquid and just kind of, easier markets to trade. So those are the three reasons why someone would trade a future. Now let's talk a little bit about how to value a future. So the difference between the future and the price of the underlying is often called the basis, or the exchange for physical. We'll abbreviate this as EFP. So the EFP is the difference between the price of the future and the price of the underlying. Apologies for my poor handwriting. So in the example of crude oil, the basis here is the difference between the price of the crude oil future for a specific expiry and the cost of a barrel of crude oil just on the market right now. So what causes this EFP? What causes this difference? There's a couple of things. Firstly, interest costs. If you were to go and buy a barrel of crude oil on the market right now, the money that you've taken to go and buy that barrel, instead you could have gone and put it in the bank and invested it and received some interest on that money. So there's a difference there. You're foregoing the cost of that interest to buy that barrel of crude oil. Secondly, there's also this idea of storage. If I go and buy a physical barrel of crude oil, I've got to go put it somewhere. I probably can't just chuck it in my backyard. I need to rent a place in a storage unit, somewhere that can actually store oil. These are two costs that you don't incur if you trade the future. So you don't have to kind of forgo this interest cost, and you don't have to pay the storage cost for a barrel. Because of this difference, if there was no difference between the price of a future and the price of a barrel of oil, you could purely arbitrage this because of this difference in costs. Arbitrage doesn't really exist in financial markets because of firms like IMC, and so this causes a difference in the price of these two products and this basis. So here's how you can value a future, and here are some of the things that cause a futures price to be different from an underlying. Another thing that's interesting about futures is this basis can be different depending on the expiry of the future. And this gives a shape called a term structure, where we can plot the basis or the price of the future across different expiry points. This leads to two classic shapes while trading futures. One, where the price of the future decreases over expiry, so we'll call this price and this time. We call this shape contango. And then the inverse, where the price of a future now is actually worth less than it will be in the future. We call this backwardation. In the example that we're going to talk about now, during COVID-19, the futures market was in heavy, heavy backwardation. This is because the price of the front month futures contract actually went negative. With this bit of theory behind us, we can now take a deep dive into what happened for the crude oil futures contracts during COVID-19. COVID-19 was a really uncertain time in financial markets. Everyone was locked down, demand was slumping, we were seeing financial conditions that really hadn't been seen since the GFC, if ever, in terms of intraday volatility, how much things were moving around, the change in liquidity profiles of markets. It was really exciting to trade, and it caused a lot of really large opportunities. So, because everyone was locked down, there was no demand for oil. No one was driving to work, no one was driving at all, no one was flying. So, all these large petroleum companies who buy a lot of oil and ship it around the globe, there was no demand for that. There was a real oversupply of oil. There was a glut in the market. Generally, when supply increases of an asset, the price decreases. The asset that we're talking about here is the WTI May 2020 futures contract. So this contract expires in May 2020, the expiry. The underlying is WTI, so crude oil, and the settlement is physical delivery. You have to get yourself to Cushing in America and take delivery of the oil that you're buying in your futures contract. And this was the interesting bit. while there was a large oversupply of oil, this meant that it was really, really hard to take or to buy oil storage facilities or to rent oil storage facilities in the US. Kind of all the oil tankers in Cushing were full. All the oil tankers around the US were really full. And so it was very, very expensive to try and find excess supply that you could take delivery of your oil contracts. Traders were aware of this and coming into expiry were starting to sell their contracts. No one wanted to be long these contracts such that you had to take delivery. So traders coming into expiry, anyone was long was starting to close their position. This was causing the price of the May futures contract to decrease. We were getting into a term structure that looked like backwardation. This didn't impact, longer dated expiries, 2021, 2023, because storage wasn't as important then. Delivery was so far away. The fact that storage was so costly wasn't impactful on the price of those futures contracts. However, for this May contract, it was very impactful. Traders were aware of this risk, and coming into expiry, some were starting to panic. We were seeing more selling in the market. And, interestingly, the price of the contract went through $0. What does this mean in real terms? You could buy this contract for less than $0. So you're receiving money to buy this futures contract, and this futures contract entitles you to take delivery of oil. So you're receiving money and also receiving oil. This seems a bit bizarre and isn't really how things work in real life. You don't rock up to a petrol station in your car, receive the fuel in your car, and then also get paid to do that. You have to pay to receive the asset. But that wasn't the case here because of futures market dynamics and futures pricing. So as we get closer and closer to the expiry time, traders are just selling these contracts. No one wants to own this asset, and we're seeing just a huge squeeze in the price of storage for oil and taking delivery of oil in Cushing, meaning that as the price of that went up, the price of the future just continued to go down and down and down. At the low of the day, the futures contract traded at negative $40. This is insanity. A standard contract for a barrel of oil is often between $80 and $120. And so you could receive $40 and also take the delivery of the oil. Yeah, this was a really crazy market dynamic, created a lot of headlines around the world, created a lot of trading opportunities for firms such as IMC. You might have even heard about it at the time and just thought, that's a bit weird, I don't really understand how that happens. Hopefully now, with an explanation of what futures are and why people trade them, a little introduction into how futures are priced, and then a bit of a deeper dive into futures market dynamics over COVID, you have a broader explanation as to how this could happen in a financial market. Thank you.
Hey everyone, my name's Stephen. I'm an index options trader for IMC, and I'm just going to talk briefly about shorting a stock. I'll mention what that is, what it involves, what the risks and reward to that position look like, and then we'll do a quick case study of GameStop short squeeze, which happened in January 2021, which hopefully some of you are aware of. So what does it mean to short a stock? Shorting a stock is essentially when somebody borrows some shares from a natural long holder with the intention of selling them in the open market and thereby betting on the decline in the value of the stock. These people think, a company is fundamentally overvalued or have other reasons to be short the stock, but essentially you're hoping for a decline in the stock price. Okay, so what are the payoffs of going short a stock? So locally it's linear with stock price, and you make money if it goes lower and lose money if it goes higher, and the P&L is just the difference between where you went short the stock, aka the price you sold it in the open market when you borrowed it originally, and then the price that you ultimately buy back the stock for. But a very important consideration is the fact that a stock can only ever go down 100%. The value of a stock is capped from below by 0, but it can go up infinity percent. The value is uncapped. So really, in the tails, the payoff is extremely asymmetric. Another important consideration is the fact that you need to pay the person who lent you the stock a cost to borrow, and then that fluctuates according to supply and demand. The supply being the supply of natural long holders that are willing to lend out their stock, and the demand being how many other short sellers are interested to short the stock. Okay, so now we'll look at an example of a short squeeze. So first of all, what is a short squeeze? A short squeeze occurs when there's a dramatic increase in the value of a stock that's being driven largely by short holders realizing losses as the stock rallies and therefore being forced to buy back the stock to mitigate their losses. And then naturally that drives the price higher and it creates a bit of a vicious cycle. So hopefully some of you are aware that this happened in the US. Stocks like AMC, Bed Bath & Beyond, and of course GameStop had enormous short squeezes that we'll take a quick look at now. Okay, so now let's have a quick look at what caused the GME short squeeze. The context is that over 100% of the free float, that is the stock that is available to trade on the open market, had been shorted by short sellers. And this means that these sellers were liable to realize huge losses in the case of a quick rally in the GME stock price. Okay, and then how about the catalyst for that sparked the squeeze? Well, the first was the rise of an app called Robinhood in the US. Hopefully some of you are aware. It's like a low fee, gamified options trading app that exists for retail customers and that made trading these options extremely easy. The second is, of course, the fact that we were in lockdown and there were stimulus checks and people were still earning disposable income, meaning without anything else to do, they turned to gambling in these options in the stock market. And then the third is the rise of retail options traders on forums like Wall Street Bets on Reddit, and influential figures like Roaring Kitty in the case of GME, like influential YouTube traders fueling the interest of retail to trade these options. Okay, so what was the result of these catalysts in the case of GME? Well, initially on the rally, the existing short interests were forced to buy back their stock, thereby mitigating their losses that had resulted from that rally. Another important result was that the option dealer market were extremely short gamma because of the amount of calls they had sold to the retail interests, who we mentioned previously in Wall Street Bets and following Roaring Kitty. Both of these factors are self-perpetuating, meaning that as GME stock rallied, the short sellers and the option dealers were forced to buy more stock, thereby driving the price higher, causing them to need to buy more stock again to mitigate their losses. And the result of this was a 23-fold increase in the GME stock price, going from $21 a share to over $450 a week later. So just to finish off, in this session we covered what it means to short a stock, what the P&L payoffs of being short a stock look like, and we quickly examined the case study of GME short squeeze. I hope you enjoyed the session.
Well, that brings us to the end of our IMC Masterclass. We hope you guys have gained an appreciation for algorithmic trading and financial markets, but most importantly, we hope that you guys feel inspired to pursue a career in trading here with us at IMC. Thank you.